Okay, let's look at some problems from Chapter 8. And I guess you could kind of categorize these as refinements or a little bit more complicated issues, if you will, with respect to capital budgeting itself. So the first thing we want to talk a little bit about is some risk, right? So we have a project that we've analyzed. We've also incorporated the reality that under different kinds of circumstances, the economy being one of those circumstances, that we could have higher or lower sales, which would mean higher or lower cash flows, which certainly could affect the net present value of our project. So in this example, we have a project that in the very best kind of economy, we would expect about a $30 million net present value. And we predict about a 5% chance of that happening. On the other end of the continuum, in a recession type of an economy, we would expect the net present value to be negative 70 million. And again, we assume there'd be about a 5% chance of that happening. So we can use what's referred to as the capital budgeting project risk analysis worksheet. And this worksheet works very similar to standalone risk, because essentially what we're doing is we're calculating the riskiness of an individual project all by itself. So when you input the data, we end up with an expected return of, it says 5.25, that's $5,250,000. The variance is $528 million. Standard deviations 22.9 million. The coefficient of variation is 4.378. So again, what we see from this, what we can gather from this, are the statistics of this particular project. We need to understand, what do we think is going to happen? We can then analyze the risk, make comparisons to other projects, incorporate the riskiness of this project to the riskiness of the company as a whole. So again, this is just an analysis, if you will, of the risk of a particular project. The second set of problems refers more to a concept called capital rationing. In capital rationing, the company is going to set a balance or a budget that it's not going to exceed when it comes to buying projects. So in this case, we have 6 projects. The cost of capital is 10%, but we're only going to spend $250,000. And if you look at these projects, the amount far exceeds $250,000. So we need to figure out, based on these projects and the constraint of only spending $250,000, what should we do with respect to the projects? Which ones should be followed through with? So the first thing we can do is we can look at what's referred to as the internal rate of return approach. You enter the projects, their investment in dollars, and their internal rate of return. We also identify, obviously, the discount rate and the capital budget constraint. And we're going to sort these. And when you sort them, you find out that as we sort them, it's going to identify the cumulative investment. So we want to go down until we spend $250 million. As you can see here, it says that we would do projects B, C, and E. Those are 3 acceptable projects. They all have internal rate of returns greater than the discount rate. And we would spend $230,000, less than the capital budget. Unfortunately, we also see that there are 2 projects, A and F, are acceptable. In net present value terms, these projects will add value to the company. But because that would require us to spend more money than we currently have, we wouldn't do those projects. So this says that B, C, and E would ultimately be the projects that we complete. Another way to do this is using the net present value approach. Again, you rank, put the projects in the grid here with their investment, and then obviously net present value instead of internal rate of return. We then rank on net present value, and of course you see here it says we should do C, B, and A. That would give us the greatest amount of net present value, but also those three projects total the $250,000. Again, we have two other projects that are clearly good projects. They have positive net present values, but we're not going to do those projects because it exceeds the amount of money that managers want to spend. In this example, we have two similar projects, but for one reason or another, they are differentiated by time. Project A provides cash flows for 5 years, but Project B, which is a similar project, is only going to give us cash flows for 3 years. So, given the way net present value is calculated, and that it is the sum of future present cash flows, the present value of future cash flows. Since it is a sum, projects that have longer time frames will more likely be chosen over projects with shorter time frames. So as you see here, Project A has a net present value of $32,000 and Project B $9,364. And again, you can put that into your capital budgeting technique spreadsheet, and that will give you those values. The next thing we want to do, though, is we want to put these on a more even playing field. And from the notes, you'll remember there are two techniques to do this. One is the annualized net present value technique, and the other is the replacement chain technique. So as you see, under the annualized net present value technique, Project A, $7,800, Project B, $3,500. So Project A indeed is the better of the two projects. And you'll get a similar answer with the replacement chain. And just to kind of show you the spreadsheet, what the spreadsheet looks like, when you put in the net present values, put in the lifespan, and the discount rate, this is what ultimately calculates the values, right? So 7805 is Project 1 versus 3568. So again, this technique would show that Project A is better than Project B when placed on an equal playing field as well. So the next thing we want to do is look at lifespan, right? We've always talked about, or you've been given problems with specific cash flows, that these are the 5 cash flows. Well, this is a question of how many years of cash flows does it make sense to have, right? So we want to estimate what's referred to as the engineering lifespan. This is the life of the project that's going to generate the greatest benefit to the company. So here we have a project, spend $100,000, and here are the cash flows we expect from each year. Now what we also need to investigate, this is what's referred to as abandonment analysis, is if this project is abandoned at the end of the first year, what will happen? Well, you're going to spend $100,000 today. The project is going to give you $50,000, but the sale of the project at the end of the year is going to give you $85,000. So the cash flows at the end of year 1 would be 50 plus 85. That's $135,000. What is the net present value of investing $100,000 and getting $135,000? We see here the net present value $17,339. Internal rate of returns 35%, modified internal rate of returns 35%, profitability index is 1.174. So again, what happens if we keep it for 2 years? Again, you're going to get the cash flow in year 1, that's $50,000. The second year, you're going to get $50,000 for doing the project, and you'll add another $65,000 from selling the project at the end of year 2. So what would your cash flow stream look like? Spend $100,000, receive $50,000, then receive $115,000. The net present value of that is $30,435, and you proceed through all the cash flows. What we will find is year 4 is going to create the highest possible net present value for this particular project. So the engineering life of this project is 4 years. You should do it for 4 years and then replace the project. Now what you'll notice is that that isn't necessarily the same for all the techniques. If you notice, the maximum internal rate of return is actually just to do it 1 year. The maximum modified internal return actually is just doing it for 1 year. So the challenge we have here is net present value is the correct technique. That's the one we should ultimately use. And again, the purpose of this is to figure out the most effective time frame to do the project and then ultimately to replace the project to maximize the value of the company over time. So here we have a company that has completed a $150,000 feasibility study, right, for this new product called HomeNet. This project has an estimated life of 4 years. What should the company do with this $150,000? And this really is another question, right? What does a company do with sunk costs? Now, in reality, companies will do whatever they want to do. The textbook, and I sort of agree with the logic here, the textbook says that sunk costs are not included in the analysis of the project. The reason for that is that those costs are spent whether you do the project or not. So if you decide not to do the project, there's no way to recover those costs. Now, if they're included or not included is not really relevant, right? If you include them in the initial investment, the net present value will obviously be less. However, depending on the company, you may or may not want to follow that particular strategy. So there's a company that's proposing a 4-year capital expenditure. And what we're going to look at here is what's referred to as a comprehensive problem. And we're going to go through this fairly quickly because once we get past the first slide, it's kind of repetitive. But I want you to see the overall process of how you would do a complete, more comprehensive problem. So in this case, the first step is we have to estimate sales. So the first year's sales, we expect we're going to sell 20,000 units. Now, these sales are going to change over time. They're going to grow on an average of 2%, and the standard deviation of that is 1%. The price per year is estimated at $100 a year, or $100 per unit, with a growth rate of 3% and a standard deviation of 0.5%. We need to use the averages and standard deviation here so we can incorporate some uncertainty into the exact cash flows based on historical analysis, for instance. So for this very first problem, I make this thing a little bit bigger here so it's a little easier to see. Here's our units, right? Our beginning part of this project. And here are the statistics. Remember, sales can grow at 2%. with a 1% standard deviation. So what this does, this first row here, calculates the growth that year of the units. So it utilizes a formula of 2% plus or minus some random number between 1%. So here we have our growth rate over time in units. So if you multiply 2.014 times 20,000, we're actually predicting 20,428 in year one. Of course, that then is adjusted by 3.2% the next year, then down to 1.17. And so I think you can see what we're doing here. The growth in price also changes over time. So in net sales for the 4 years, we expect 2.09 million to 2.08 million over this time frame. Again, every year will be different because every year has different statistics involved in calculating the values. We do the exact same thing with cost of goods sold. Again, make this a little bit bigger for you to see. Again, including means, standard deviations, other numbers that we may have. That then allows us to calculate the variable cost per unit. Down here, the total cost of goods sold for all these units. Again, we see 1.7 million to 1.74. Again, different numbers every year because not only does the value change, but also the statistics change. We need then to calculate the administrative expenses. Again, based on the same types of analysis where we predict some value to start with, and then over time there is some change. Now, one of the things you need to know is that every year you do have to have the numbers in these cells for the spreadsheet to work. There always has to be values here. So we're saying advertising, is going to be 0% per year, and we have to have a standard deviation in here, even though we're saying it's fixed. That allows the formulas to actually work. So the next thing we do, we need to look at working capital and how working capital changes. Again, we have some ratios for days sales outstanding, for our inventory carrying, etc. We know what the current values or the amounts are. And we have some other ratios we put in there. This tells us what our net working capital will be each year. The next thing we need to do is we need to talk about assets. What are we going to buy? We're going to buy one asset for $500,000, has a 3-year depreciable life. And at the end of 4 years, it's going to cost $2,000 to scrap this asset. So where do we put this information? Again, there is a section of this spreadsheet for asset purchases. Here's the purchase, right? We also shows at the end of the 4th year, what cash flow are we going to get from this project? We're actually going to spend $2,000 to get rid of it. If we had sold this, we might want to have a positive amount in here to show that there's a positive cash flow coming into this particular project. So the next thing to do, let's calculate the income statement. So the only thing we have to incorporate here is what is the marginal tax rate. There's a cell for that. In this case, here's the net income of this project. See, the first couple of years we have negative income, but then we start making money in year 3. You need to calculate then the balance sheet. Again, we're not calculating this. The spreadsheet completes this for us. Shows us the total assets that we have in the company. Shows us accounts payable. What you'll notice is there's no long-term financing included. Why is that? In capital budgeting, the discount rate is also the cost of capital. That's the cost of financing. So it's incorporated in the discount rate. So we don't want to include it or take it into account twice. Next, we convert our cash flows, or our income statement and our balance sheet. We convert that into a free cash flow statement. So here then is the timeline, the cash flows for this particular project. We're going to spend $580,000 the first year, $500,000 on the asset, and $80,000 on cash on the working capital of the company. First year we'll get $413,000, then $176,000, $118,000, and then $143,000. We then incorporate this into capital budgeting techniques. Now, in this comprehensive worksheet, there is a place to put the discount rate and I believe the reinvestment rate so that it will calculate a few of the capital budgeting techniques for you. On the other hand, you can also transfer those numbers into the into the capital budgeting technique spreadsheet. You see I've done that here. The net present value is $104,908. 22% is the internal rate of return. And again, you notice we have a 12% discount rate. 17% is modified internal rate of return. Replacement rate's 14%. So again, we can incorporate that and now look at the statistics and determine whether this is a project we want to do or not. You can look at the net present value profile, right? It shows you the steepness of the slope, shows you in general what the net present value is at the various discount rates. So this comprehensive table really is just here to incorporate the uncertainties of what's going to happen in the future. So there may be a problem that we do later on that will incorporate all of this riskiness, and or you may be asked to do this in just a general homework problem.